Have you ever wondered how a financial institution manages the risk of selling massive option contracts? Today we are going to break down exactly that using a real-world example. Hi, I am Dr. Tamrat, and on this channel we help students master financial concepts with practical examples and easy to understand breakdowns. In today's video, we will explore how financial institutions manage the risk of selling a European call option on shares. We will walk through key details, how traders use delta hedging to control their exposure to risk. If you are studying finance or want to improve your understanding of option trading, do not forget to subscribe for more examples and tutorials. First, dynamical delta hedging is one of the strategies to manage risk. What is risk in finance? It is a potential loss in value from changes in price, interest rate, or market condition. So managing risk is essential to protect portfolio value from market fluctuation. Hedging is reducing risk by taking an opposite position in related asset. The main goal or the objective of hedging is not for profit, but to protect the assets against loss or fluctuation. Hedging with delta, which measures how sensitive an option to price change in the underlying asset. As delta changes, traders adjust their hedge to stay risk neutral. Let us see a real situation or a scenario, or this example. Assume a bank has sold European call option on 100,000 shares of non-dividend paying stock for $300,000. In this scenario, the current price is 49, the strike price is 50, the risk-free interest rate is 5%, volatility 20%, time to maturity is 5 weeks, and the expected return of this underlying asset is 13%. If we calculate the Black-Scholes price, or the price using the Black-Scholes formula, let us see here the Python code. I already prepared a function which evaluates analytically the call option. Here the function is called Black-Scholes analytical. So it takes the current price, the strike price, the time to maturity, interest rate, and the volatility, and the type of the option, in this case call option by default. So this is the function which calculates the Black-Scholes formula, which we already discussed in detail in previous videos. So in our example here, our parameter is the current price, the strike price, interest rates, and the volatility, and time to maturity is 20/52, because we assume that in a year we have 52 weeks. So if you calculate the option value per share, it is $2.4. So if we multiply by 100,000, we'll get $240,000 for the 100,000 shares. But in our example, the institution or the bank has sold for 300,000. So the question is that for the next 20 weeks, how does the bank hedge its risk to lock this $60,000 profit that is obtained from the difference of $3,000 minus the real price was $24,000. So the difference is $60,000. So how does the bank hedge its risk against fluctuation for the next 20 weeks? There are different strategies. The first strategy is naked position. That means it takes no action. Once the bank sold the share, then it will wait until 20 weeks without taking any action. So what is the risk associated with this strategy? So if the stock price is less than the strike price after 20 years or after 20 weeks or at maturity, the strategy works well because the contract holder will not exercise his right. Therefore, the bank will profit the premium which is obtained during the agreement. But in other scenario, if the price of the underlying asset is greater than the strike price 50, then the contract holder has the right to exercise his right. So the institution will have to purchase from the market this to pay its obligation. That means it has to purchase 100 shares from the market to cover the call. So in this case, this will result in the loss of the institution, calculating that, because for instance, if the price at maturity is 60, the position will cost the institution this amount. This will result in the loss of the institution, calculated as this one, that is the difference between this and this. It will be negative 1,700,000, which is very huge. The next option is the covered position. That means the bank will buy 100,000 shares today. That means during the contract. The risk, what is the risk associated with this strategy? If again the stock price at maturity is greater than 50, then the call will be exercised. Since the institution has already purchased the share, there will be no problem covering the call. In this scenario, the institution will gain the premium charged for the position, which is $300,000. But if the price at maturity is less than the strike price or less than 50, for example, if it becomes $40 per share, the bank will incur a loss of almost $1 million on the stock position because it already bought this amount. So the loss is significantly greater than this amount which is charged for the option during the contract. So neither naked position nor the covered position provide a good hedging strategy. The other strategy is stop loss strategy. That strategy is buying the same amount of share as soon as the price reaches near the strike price, which is 50, and selling this amount of share as soon as the price falls below strike price, which is 50. So as you can see from the diagram, at this position the bank will buy 100,000 shares, and for example here it will sell, buy, sell, and so on. Ignoring the discounting, the cost of writing and hedging, the option appears to be maximum of S0 minus K or 0. The problem in this case is transaction cost, because buying and selling frequently will not be feasible. The other option is using delta, Greek letters, as a partial derivative with respect to the model parameter that are liable to change, and usually traders use Black-Scholes-Morton model when calculating partial derivative, and the volatility parameter in Black-Scholes-Morton is equal to the implied volatility. When Greek letters are calculated, this refers to us using the practitioner's Black-Scholes model. So today we'll focus on the delta. The delta is the rate of change of the option price with respect to the underlying asset. That is, if this C is the call option, then the S is the underlying asset, then the partial derivative of the call option with respect to S is denoted by delta. So in this diagram, the blue one is the stock price against the option price, and the dotted or the broken red line indicates the slope, for example, at this point. So the slope is just the rate of change of the call option with respect to underlying assets. Then it measures which is known as the Greek letter delta. So what is the importance of this example? If delta is 0.6, that means if the slope is 0.6 as indicated in the previous diagram, so when the price changes by a small amount, that means this is the relation delta is equal to partial derivative of the derivative with respect to the underlying asset. So if delta is 0.6, So when the stock price change by a small amount, the option price change by 60% of the amount, right? That means we can write in this way: delta C, delta of the option is equal to 0.6 times delta of the underlying asset. That means price change in the stock result in the price change in the options with this proportion. For example, imagine an investor who has sold a call option to buy 2,000 shares on stock. So the investor position could be hedged by buying this amount. That means delta C is equal to 0.6 times delta S. So this is the proportion of the number of shares you have to hold your position for hedging. So if you multiply this by 0.6, you will get 120 shares. So the gain or loss on option position is offset by loss or gain on stock position. That means the gain on the option position is offset by the loss on stock position, as well as the loss on option position is offset by the gain on stock position. This table shows some scenario. That means if the stock price go up by one unit, or here delta or the change in the stock price is 1, and then delta C is equal to 0.6 times delta S. If this increased by 1, then this will become 0.6 positive. So there is a loss on the option, right? There is a loss on the option. That means because of the position of the writer, there is a loss due to increasing the price of delta, which is minus 1200. But there is a gain on the stock because the stock already increased by this, so with this amount. Therefore, if there is a gain in the stock but there is a loss in the option, they are equal in magnitude but they are opposite, they offset, or they cancel each other. Another way, if it is a decrease in stock price by -1, then there will be a decrease in the price of the option. Therefore, there is a gain in the option but a loss in the stock. That will cancel, giving us delta neutral. So the delta of the traders over all position in our example is 0. Position with delta 0 is referred to as delta neutral, right? And delta change as stock price change and the time passes. Hedge position must therefore be rebalanced, right? So to rebalance, we use a replicating portfolio. Replication of portfolio of call option C of T needs to find self-financing portfolio. This is a portfolio that means theta comma delta, which is a pair. This is between 0 and maturity. Here delta is a position in the share and the theta is the position in fund. That means you may take money from bank to buy the share. So our option or value should be equal to delta times S plus theta times B of T. Here BT represents the value of the risk-free asset at time T, and initially the risk-free asset is equal to 1. We can start from 1 without loss of generality. So to replicate our portfolio at any time T, we use the Black-Scholes-Morton formula. Here, remember that the Black-Scholes-Morton formula is given by this one, right? So you see our delta is this one and our theta will be this one. Rearranging this equation, you will obtain this one. Obviously, we have the following. From the Black-Scholes-Morton formula, our delta is equal to n of d1. Here D1 you remember in the previous video, and our theta will be this one. That means to replicate our portfolio at any time t, right, we have to hold this amount of the share and also this amount of risk-free assets, right? So that means in the long position of these units of the share, the underlying asset, and in the short position of these units from risk-free assets, right? So the key point is to relate this one with the Black-Scholes-Norton formula. Now we'll see example. This is an example. Assume a stock currently trading with this amount behaves according to geometric Brownian motion with mean return of this amount 6% and the volatility is 30%. And risk-free interest rate is just 3%, then find the replicating strategy of 1 year at many call option. One at inception, that means when the contract is written, after 6 months in the scenario where the price becomes, after 6 months, the price becomes from 100 to 150, and just before maturity in the scenario, when the time closer to 1 year, the price becomes just before the maturity, the price becomes 107. I already prepared here a function called replicating portfolio. As you can see, this replicating portfolio takes the parameter t, time, at any time t, the price of the stock at any time t, strike price, risk-free interest rates, maturity, volatility, and there's a type of option here. So we calculate D1 is, you see, given by this expression, and D2 is given by this expression. So our delta is the CDF of D1. The cumulative distribution function for the standard normal distribution evaluated at D1 is our delta, and our theta for call option is, as we already see in the slide, minus e to the power of minus r capital T k, and CDF evaluated at D2. So now using this function, now we insert the parameters. You see the initial price is 100. The strike price is given also 100 because it says at the money call option, and the volatility is 0.3, and the risk-free interest rate 0.03, and the time to maturity is just 1 year. So at inception, our t will be 0. Our t will be 0 at inception. So the output will be, of course, the price of call option, then delta at t is equal to 0, and the theta at t is equal to 0. So if we execute this code, so at inception, you see we have this value. That we have to be in a position of this proportion, right, for each share, 0.5987. That means if we sell 1,000 share, or if the institution sell 1,000 call option, then this multiplied by 1,000 will be the position of the institution in the share. So to achieve that, it has to borrow 1,000 times this amount, or this amount for each share from the bank or from the risk-free interest rate. And in the same way, after 6 months, that means time is equal to 0.6, the price becomes 115. Then we insert here all the necessary parameters. Once we execute, you see the position of the institution In the long position for the share should be 0.79. Again, if the number of options sold is 1000, then 798 shares should be in the long position for the option writer. The third one is just before maturity, the price becomes 107. So in this case, we take a number closer to 1, just 0.999. We can make it 0.99. Then inserting all the parameters, as you can see from the code. If we run, our delta becomes 1, right? That means the price of the underlying asset becomes greater than 100. Since it is greater than 100, the payoff is positive, then the option holder will exercise. So in order to hedge against the risk of losing, the institution should hold 100% of the share. So the delta should be equal to 1. Thank you very much for watching. Please subscribe for more